Good morning, good afternoon, and good evening, distinguished attendees, experts, and participants, wherever you are in the world. My name is Jana Araji. I am currently joining you from Lebanon. As I get ready to kickstart my career as a legal professional in the field of international law, it gives me great pleasure to be here with you today and to host this panel to discuss a topic that is particularly close to my heart because I believe that when we talk about developments in relation to digital economy, we are potentially witnessing history in the making. So because of that, I would like to thank everyone at the Hague Conference on Private International Law for doing such a great job in putting this together and organizing this conference to particularly discuss these developments that may or may not transform the legal frameworks we know today. So I would like to particularly thank Dr. Geraldine Go-Escolar and Harry Cheng for the tremendous work that they've been doing for the past few months and for making this possible and for inviting me and our experts to this panel. Now, more about the topic or our session. As part of this track that is titled Redefine, and which aims to identify fintech developments and private international law challenges that are caused by the fintech industry. The aim of our discussion today will particularly be to explore current approaches to fintech and distributed ledger technologies regulations with a particular focus on cross-border challenges that arise from these applications. In particular, the geographical focus of our session would be on the Asia Pacific and MENA region. Of course, I am well aware that this is a particularly big region, a big geographical area. So the aim is really not to give a holistic analysis of all the developments that are happening, but the goal is really to identify certain examples or trends happening in the region, certain countries, to be able to determine the current digital economy trends. So without further ado, and for this purpose that I've just mentioned, we are honored to welcome two experts who have had extensive experience in relation to efforts to digitally transform economic and financial activities. I first came across their work during my internship at the Hague Conference on Private International Law, and I quickly became a huge fan. So today is really extra special for me personally, but I do believe that their specific expertise is really crucial for today's discussion and for the conference in general. So I do hope our attendees get to discover as much as I did on this topic. Now, the way I intend for the session to go is I will give the floor to our experts to introduce themselves and to tell us more about their line of work in digital economy before I move on to certain questions that I've prepared that I believe they cover a wide range of topics in this area. So I will first give the floor to Dr. Umar Oseni, Chief Executive Officer of the Islamic Liquidity Management Corporation, currently joining us from Malaysia. Dr. Oseni, would you like to say a few words?
Yeah, thank you, Jana, and thank you for having me. And I'd like to thank the Hague Conference on Private International Law for inviting me for this session. And I think I've worked with the HCCH before. You know, we've had some previous interactions on issues relating to child abduction. I mean, it's completely different from why we are here today. I'm currently the Chief Executive Officer of the International Islamic Liquidity Management Corporation. It's a multilateral financial institution that is headquartered here in Kuala Lumpur, Malaysia. And prior to this appointment, I was the executive director and the acting chief executive officer of the same institution. At some point in my career, I was an associate professor of law and regulation of Islamic finance at the International Islamic University of Malaysia. And I was also a visiting fellow at the Islamic Legal Studies program of the Harvard Law School in the United States. That was over a decade ago. And apart from being a Harvard certified negotiator and a dispute resolution expert, I have consulted for numerous bodies in the areas of law and regulation of Islamic finance, and I have a kind of humble kind of blend of both academic and industry experience. And I've consulted for a number of international bodies, including the Islamic Development Bank, the OIC, COMSEC, as well as some other UN agencies. I'm a member of both the Nigerian Bar Association as well as the Canadian Bar Association. I hold a PhD in law and 2 master's degrees, one in comparative law and another one in financial laws. Thank you.
Thank you very much for the introduction. It's a pleasure for us to have you with us. And Dr. Heba Abdel Monem, we have you with us. Dr. Heba is the head of the technical office sector of the Information and Decision Support Center of the Egyptian Cabinet. Would you kindly like to say a few words?
Yes, thank you, Jana. Thank you for inviting me to participate in this conference. I am Dr. Heba Abdel Monem. I have 27 years experience in economic research. Now I am the head of the technical sector in the IDSC as the Egyptian Cabinet of Ministers. Before, I was the chief of studies and statistics division at the Arab Monetary Fund. I have launched the Digital Economy Initiative for the Arab region in 2020, which is mainly aims at encouraging the digital economy in the Arab region and explore all the gains that the Arab economies could have from using digital application and fintech application. I represent the Arab region in many international venues like the G20 summit, which in 2020, which was during the KSA presidency of G20, and also in the Basel Committee on Banking Supervision. I have many published research in economic issues in general and digital economy in particular. And recently I launched a recent study on issuing central bank digital currencies in the Arab region. I have a PhD in macroeconomic and a master in international economy. Thank you so much.
Thank you very much, Dr. Heba. It's a pleasure for us to have you with us. I think the fact that you both come from very different backgrounds, so from a legal and an economics background, I think this will really be valuable for our discussion because it will really give us that interdisciplinary outlook or perspective on the matter. So I would definitely be taking advantage of that, and I would be asking your insights on sometimes similar topics. So without further ado, like I said, I prepared a few questions that I would like to kindly ask you and get your insights on. First of all, to set the tone of our discussion and to just give our audience a short introduction of the topic, I would like to maybe ask you to give us a brief introduction or a presentation of the current approach to fintech regulation or certain trends that can be identified in the region, and particularly the underlying reasons for opting for this or that approach. Dr. Heba, would you like to go first on this one?
Yes, thank you so much. Thank you, Jana. And first of all, I would like to refer to the fintech market in the MENA region in general. And it's actually witnessed a significant growth in the last years. Now, the fintech ecosystem is estimated at around $15.5 billion. And this is the fastest growing region across the world with 90% annual average growth, mainly dominated by 3 major Arab countries, which are UAE, KSA, and Egypt. And is mainly the major segment of fintech industry in the MENA region is digital payment, actually. So based on the very important role played by the fintech industry, the regulatory authorities in the Arab region were very keen to have a conducive regulatory framework to regulate fintech industry in the Arab region. And this is mainly due to 3 major reasons. The first is to to increase financial inclusion. And as you know, despite the significant success of the Arab countries in increasing financial inclusion in the Arab region to reach around 40%, according to the recent data of the World Bank, it's still lower than the global average, which is around at 76%. Second reason is to encourage access to finance for SMEs, and SMEs is a very important segment within the Arab economy. They contribute around 45% of the GDP and employ around 1/3 of the formal employment. And the third reason is the role of fintech actually in achieving sustained and inclusive economic growth and achieving SDGs goal. This mainly is based due to the role of fintech in empowering women, youth, SMEs, inhabitants of rural areas, and also in reducing poverty and creating more job opportunities. So based on this background, the regulatory authorities was very keen to regulate the fintech industry in the Arab region, actually through three major regulatory approaches. The first one is a general approach. So you can see specific laws that already enacted to encourage fintech industry in the Arab region. And here we can refer to the example of Egypt, where the Central Bank of Egypt in 2020 issues the Central Bank Law, which already contains a specific chapter for fintech, for encouraging fintech. This law already include articles that allows the central bank to establish regulatory sandboxes for fintech, and also to exempt fintech companies from all the regulatory requirement for licensing. In addition, also the law gives the central bank the authority to identify all the requirements, standards, and authorities for the fintech companies to have access to banking accounts, and obligates banks to allow the access of fintech companies to the bank accounts of the customers once this fintech application fulfill the central bank requirements. On the other hand, also, and recently in 2020, the Egyptian Financial Authority, which is concerned on regulating the non-banking financial activities, already enacted a law for fintech, and also to encourage using fintech application in the non-banking financial services, and to increase the efficiency of these services and allow them for a diversified segment of the Egyptian society. This law already regulates fintech uses in 5 main areas, including insurance, microfinance, consumer finance, robo-advisory, and the stock markets. Also, the most important part of this law also is to allow the Egyptian Financial Supervisory Authority to use artificial intelligence in monitoring and tracing all any financial risks that could arise from or could threaten the financial stability. So we could say that this is a general approach to regulate fintech industry in the Arab region. And the approach in general concerned on identifying the license requirement and include articles that deal with or ensure consumer protection, cybersecurity, risk governance, all other and also all other aspects that relate with compliance with international and international standards related to anti-money laundering laws and terrorist finance, and also KYC regulations. In some Arab countries, this approach is complementary by enacting other laws at the national level, like digital payment laws or digital identity laws or other complementary laws. On the other hand, the second approach adopted in the Arab region is to enact some regulation that regulates certain aspects of fintech industry. So you can see some regulation issued by the central bank to regulate, for instance, digital payment or crowdfunding platforms or any other fintech area. And the interesting part of these regulations that they are in some cases distinguish between Islamic and the conventional fintech application, and in some cases also put some regulations that regulate or govern the competition between the banking sector and the fintech sector. So in case of crowdfunding platform, the regulation adopted in United Arab Emirates and Bahrain already contains articles that already put a limit or a ceiling on crowdfunding that could be gathered from any platform during the year or devoted to any specific customer from the different crowdfunding platforms played or acting during the year. On the other hand, also there are many regulations that govern the use of fintech application for regulatory and supervisory uses. And hence, in this case, we are talking about RegTech and SupTech uses. Either from the banking sector or the financial service providers or from the regulatory authority. Now, moving to the third approach, which is very important to encourage the fintech industry in the Arab region, which is regulatory sandboxes. As you know, the regulatory sandbox is very important mechanism to encourage the fintech industry, and through this mechanism, central banks or any other regulatory authority allow the fintech companies to work within a governed environment and to test their ideas and business model and give or provide their financial service to a limited number of customers. And in this case, these companies already having a lower regulatory platform or less regulatory requirement. So in this case, central banks and regulatory authorities are able to diagnose and test the business model of fintech industry, and in this case, in a well position to develop or formulate the regulatory frameworks that could deal with such evolving technologies, and at the same time lowering any risks that could arise from this business model. For now, we have around 9 active regulatory sandboxes launched by the Arab central banks, and actually these sandboxes are very successful and helped the Arab central bank to issue many new laws or amend the existing laws based on the experience of fintech companies. So we have now the Central Bank of Bahrain already launched the regulatory framework for open banking and financial digital consultation services based on the experience of fintech companies working in the regulatory sandbox. On the other hand, also the Saudi Central Bank also amended many regulations related to digital authentication and microfinance and the crowdfunding platform based on the experience of these regulatory sandboxes. So collectively, these three major approaches to regulate the fintech industry in the Arab region are working together, either at the national level or at the level of the industry when we are talking about specific regulation, or even major mechanisms to encourage the evolution of fintech industry through or via the regulatory sandboxes. Thank you, Jana. The floor is yours.
Thank you very much, Dr. Heba, for your very valuable contribution. And I think it's pretty safe to say that in the region, from what you've mentioned, is that the approach is to encourage fintech applications while also maintaining a very strict or robust regulatory approach.
Yes.
So it's very interesting to hear from you. Thank you. I'd like to hear from Dr. Umar if he's still with us.
Yeah, sure.
Thank you.
Thank you, Jana, and I'd like to thank Dr. Heba for the kind of comprehensive foundation she provided, in terms of the regulatory approach for fintech and the overall digital economy. I think this is actually similar to what we've seen basically here in Asia Pacific, to be very specific, Southeast Asia. We've seen regulatory sandboxes from the central bank as well. I mean, the Central Bank of Malaysia, and we've seen similar efforts in Singapore as well. And generally, I guess these are all meant to attract foreign businesses into the country, and there's this kind of race to become the new hub for financial services all the time. I mean, among some of the countries, Singapore is far ahead. You see Malaysia trying to catch up as well, trying to tap into new areas, so I'm going to go into those aspects later. Now, if you look at the digital development global practice of the World Bank, they actually said about 15% of the global GDP comprises the digital economy. This itself implies that the digital economy has been growing faster than the global GDP by 2.5 times in the past 15 years. It is believed the digital economy will continue to grow rapidly with over 6.3 billion global mobile cellular subscriptions. So this is actually what we're seeing globally, and also in Southeast Asia, we're seeing this kind of the impact of the digital economy. I'm going to go into specific details on the size and some other aspects of it later when we get into the legal issues. Now, if you look at the modern emergence and proliferation of digital economy in an unprecedented form, which is really, it's like spreading like wildfire everywhere. It actually has new private international law challenges, which require the attention of key policymakers. Similarly, while cross-border data flows and transactions are inevitably crucial to development, they also actually pose significant challenges which require concerted efforts to protect financial consumers and ensure data privacy protocols are adhered to. Now, with particular reference to digital transformation in the financial services sector, there is a need to examine recent developments in light of increasing hyperconnectivity involving financial consumers, financial institutions, and startup firms. Not to talk about, internet-based machines and applications like mobile technology and the ubiquitous Internet of Things, the IoT, within the general purview of existing local and cross-border regulations. While there's always a focus on other key issues that underpin, a successful digital economy, less attention is often given to regulation, particularly when it comes to cross-border regulation. And I guess that's why we're here to discuss some of these pertinent issues today. For instance, in a write-up from the Harvard Business Review, 4 key things were identified for a successful digital economy. There are customer expectations, product enhancement, collaborative innovations, and organizational forms. Undoubtedly, these 4 key issues are important from the perspective of the firms. But there is a further need to consider these issues from the prism of regulators and even cross-border regulation, since digital startups do not operate in a vacuum, even though of recent regulation has been trying to catch up with the fast-paced innovations in the digital economy. Now, various jurisdictions across the world adopt unique regulatory frameworks, as Dr. Heba has explained, and some of those kind of approaches are also true for Southeast Asia. I mean, there's really no difference. You talk about the supervisory and regulatory approach, you talk about the sandbox approach, regulatory sandbox approach, which is good. And the central banks actually, what I noticed is, most of the time, they actually have a common kind of frameworks at the level of either the IMF or, the BIS generally. So this is where they coordinate most of these things. And I guess at the end of today's discussion, we're going to look into some form of collaboration. The need for such collaborations, even with HCCH in developing some kind of guiding principles for the cross-border kind of market. Various jurisdictions across the world adopt unique regulatory frameworks in addressing challenges posed by DLT as well as fintech applications. While every economy seeks to attract businesses to boost their foreign direct investments, regulations can either make or mar the enabling business environment, depending on how such regulatory approaches are designed. If not properly crafted, some quick regulatory interventions, which may be well-intended to provide a level playing field for fintech players, could be counterproductive if not properly crafted in a fast-moving fintech industry where regulation keeps chasing innovation. As correctly identified in a study published by the International Monetary Fund a few years ago, technology often moves at a dizzying kind of pace, generally, while regulation keeps, trying to, catch up with the fast pace of innovation. There's no doubt in the fact that robust fintech regulation has its advantages to national economies that are embracing DLT as well as fintech applications. However, introducing regulations will actually help to boost their economies and attract more FDIs. Beyond attracting businesses, boosting FDI inflows, and ultimately increasing their GDPs, national economies should consider regulatory approaches that will help secure consumer privacy, trust, and security where most private international law issues haven't emerged. We're going to go into specific issues as we continue with today's session. Thank you.
Thank you very much for that introduction. And you mentioned quite a lot of things from different cross-border issues that we're seeing, the different regulatory approaches, and how important these developments are to boosting economies and just attracting businesses. And I thought of a follow-up question, if that's okay with you. I've heard certain opinions that say that all these developments have been accelerated by the pandemic because of the hit that many economies took around the world. And they say that all these developments were emergency measures, maybe even exceptional. Once we go back to normal life, we won't need these anymore. So there's no point in really focusing on regulations that specifically cater to these issues. What do you think of this? Do you think that these trends are here to stay, or we're still in that exceptional phase?
Well, thank you, Jana. I think these trends are here to stay, definitely. I mean, you can see this from the different regulatory approaches adopted across the world, particularly, now we're talking about the MENA region as well as Asia Pacific. I mean, if you look at even the specific nature of this legislation, they are quite clear. Those coming from the central bank, those coming from the Securities Commission in different jurisdictions, they are quite clear in their approach. They are not emergency legislation that are meant to actually solve the immediate problem. Fintech has come here to stay, and the laws are quite clear about this. And one thing people often say is that the fourth industrial revolution has been fast-tracked by the pandemic, the COVID-19 pandemic we had recently. We are here today, having this virtual session, even though we are no longer in a pandemic period. That tells you that these kinds of sessions have come to stay. Virtual meetings and virtual events. Similarly, legislations actually have come to stay. And if you look at all the existing legislation relating to fintech and even the digital economy, they are all far-reaching, laws that do not really specify that they are meant for emergency situation, basically. So I guess the COVID-19 experience was a blessing in disguise, and going forward, perhaps the world will have to embrace the technology in everything they do, particularly in the financial sector.
Perfect. Thank you. Thank you. And you're right. I think today more than ever, I'm very grateful for technology because I mean this it made this meeting possible. We're in 3 different countries around the world, and we can have this discussion easily. So I'm very thankful for that. So I'm just going to move on to my next question. But also I will refer to certain points that you both mentioned. You've mentioned this will or movement to test out certain policies through sandboxes or others. And I was particularly curious about a specific approach to regulation, and that is regulating within free zones. Now, Dr. Heba, you've mentioned Qatar, Bahrain, UAE, those countries that are really setting themselves as trendsetters in the region and in the fintech industry, in the economies. But the way I'm seeing it is that they're really focusing on sometimes in certain regulations, or they're really focused in free zones. So I would like to really jump off that idea of experimentation and ask, what exactly is the role of these free zones? Can we assume that they are being used as some sort of laboratory to test out certain regulations? And then once we see a certain positive experience within that geographical area, only then will we see more countrywide policies?
Okay, thank you, Jana, for this question. And actually, the Arab region is a home to a number of renewed financial free zones, as you said, including the Dubai International Financial Center, the Abu Dhabi Global Market, ADGM, and the Qatar Financial Center, QFC. Actually, Dubai International Financial Center is one of the world's top 8 onshore financial centers and leading financial hub for the MENA region, Africa, and South Asia. Abu Dhabi Global Market is one of the world's most innovative financial centers and has been ranked as a financial center of the year for the MENA region for 2 consecutive years. Also, Qatar Financial Center is a leading offshore business and financial center that aims to promote Qatar as a major business and commercial hub at crossroads between East and West. Actually, financial free zones working in the Arab region offer financial investors and companies a wide range of advantages, including a high-quality independent regulator, a legal framework that supports cross-border activities based on the prevailing English common law framework. Also, they have a commercial and regulatory environment conforms with international best practices and is distinct from the domestic regulatory environment. And some of these financial free zones also has tax efficiencies that reach zero taxes for 50 years on profit, capital, or assets in some cases, like in Dubai International Financial Center, and zero tax on employee income. And they also allow for 100% foreign ownership. And they also they have independent digitalized court and dispute resolution mechanisms that based on international standards, and they already characterized by risk-based regulatory approaches. Now we can see that financial free zones working in the Arab region play an important role in supporting fintech industry through 2 main approaches. One of them is initiating fintech regulatory sandboxes, as you have previously mentioned. These sandboxes aim at providing all the technical and financial support to financial startups, or through collaboration even with central banks in the Arab region and other concerned entities in implementing national projects that aim at increasing the efficiency of the financial services using fintech application, especially, as you mentioned, DLC. Actually, DIFC Fintech Hive is the first and largest financial technology accelerator in the MENA region, Africa and South Asia. And today, DIFC offers one of the region's most comprehensive fintech and venture capital environment, including cost-effective licensing, fit for purpose regulation, innovative accelerator programs, and funding for growth stage startups. As a result, the Dubai International Financial Center has created the region's largest fintech market with more than 600 fintech startups with a 60% market share of fintech companies within the MENA region. On the other hand, the Dubai International Financial Center Regulatory Authority has released the first part of the regulatory framework for digital token to open up trading of the fast-growing asset class using distributed ledger technology based on blockchain. Also, within the same context, some national projects have been launched recently by the ADGM, which is Abu Dhabi Global Market, in collaboration with a consortium of key players of the UAE largest financial institutions to develop a proof of concept to decide the governance and operational framework requirements of the eKYC national utility based on DLT technology. So, as you mentioned previously, these financial free zones now playing a very important role in encouraging fintech industry, and they already benefit from the regulatory approach that already coped with the international standards. Thank you so much.
Perfect. Thank you. Thank you very much for that answer. And now, Dr. Umar, I would like to get your legal perspective on this matter and benefit from your experience in Southeast Asia.
Absolutely, yeah, thank you. Now, in the Asia Pacific region, though financial free zones have been used generally in a few cases to streamline the regulatory framework for DLT and Web3 applications generally, what we have seen in most cases is the use of regulatory sandboxes by central banks and monetary authorities, which has been quite effective in spearheading fintech applications. However, with specific reference to financial free zones, in November 2017, Malaysia introduced what it calls the Digital Free Trade Zone, which is primarily meant to facilitate seamless cross-border trade and enable local businesses to export their goods with a priority for e-commerce. This is easily done through collaboration with Alibaba as the e-fulfillment logistics hub and e-services platform, and establishment of what they call the Kuala Lumpur Internet City, which will be the primary digital hub for the Digital Free Trade Zone. Now, since its introduction, the Digital Free Trade Zone has helped small and medium enterprises grow tremendously. This is considered as the world's first digital free trade zone. And it's really considered by most experts as an attempt to put Malaysia's SMEs onto the digital Silk Road through the e-commerce platform. And if you look at some of the kind of benefits or kind of advantages that can be derived from this digital free trade zone, I guess there are quite a number of them. I'll just walk you through about 6 of them. One of the objectives is to facilitate what they call a seamless cross-border trade using e-commerce through virtual and physical facilities. And this digital free trade zone also helps to increase SMEs goods exports from $38 billion to create over 60,000 jobs and support $65 billion worth of goods moving through the digital free trade zone by 2025. I mean, this is the aspiration of the Malaysian government at this point. And you do have some other kind of advantages like nurturing an ecosystem to drive innovation in e-commerce and internet economy. Though I do not really have the latest numbers, it was reported that as of 2019, over 13,000 local SMEs benefited from the digital free trade zone. It is thus clear that the experience of fintech regulation through different frameworks and government policies have been positive in this zone. The digital free trade zone experience was not based on any regulatory sandbox to test out the efficacy of some relevant regulations, even though it is expected that the digital free trade zone will help boost e-commerce through seamless cross-border trade while boosting goods export. SMEs are still required to comply with the documentation requirements for exports, particularly from importing countries. Now, looking at the WTO framework, I'm sure, most of the listeners are familiar with the sanitary and phytosanitary measures agreement under the WTO. there are minimum legal standards relating to sanitary and phytosanitary standards that must be met in export businesses involving food and healthcare products. Some of these non-tariff measures or non-tariff barriers may need to be properly addressed to boost global trade enabled by e-commerce. Another legal measure taken by the Malaysian government to boost e-commerce through the Digital Free Trade Zone is its announcement in the year 2018 budget that goods bought online from e-commerce platforms that are worth $200 will be exempted from tax. This diminished value of $200 is expected to encourage imports into Malaysia on the e-commerce platform. I would like to share, another example from a different jurisdiction, and I'm sure we've mentioned about the Abu Dhabi, global markets, the DIFC as well. I mean, these are very active, free trade zone. Now you also have the Dubai World Trade Center Authority, which is a regulatory body, trying to introduce regulation to actively regulate crypto trading. The Dubai World Trade Center Authority has collaborated with crypto exchange Binance to develop a crypto regulatory framework. Two key areas of focus of the regulation are anti-money laundering standards and cross-border transactions. The new regulatory framework is expected to help track cross-border transactions generally. However, there is still the issue of jurisdiction. Despite the greater privacy provided in blockchain-related transactions, it appears there is the complex jurisdictional challenge. How do you determine the residence country for a cryptocurrency software when the ledger itself does not have an actual physical location? For me, this is a legal issue that should be considered from the cross-border perspective generally, rather than just a nationalistic approach to it. Another challenge is the location of various nodes of a typical crypto transaction. Nodes of a single crypto transaction may be located in different jurisdictions. In essence, such nodes are subject to conflicting legal frameworks. This can generally be addressed through private international law rules. In addition, the cross-border nature of blockchain transactions makes it difficult to determine the applicable governing law. Beyond the governing law, how do you determine the forum for dispute resolution? Apart from this, I have other concerns relating to tax treatment, intellectual property, privacy issues, data theft, which may require some cross-border concerted efforts. And I'm sure some legal experts have written a lot, on these topics generally. Thank you.
Thank you very much for that contribution and for highlighting certain private international law issues such as jurisdiction. I think really the whole aim of CODIFI is to really determine these specific issues and try to find solutions for them, because I think we are still at the very beginning stages of trying to figure out how to deal with these issues. So thank you very much for that contribution. Once we've covered the general approach to regulation, I'd like to move on to a more specific area, and that is the area of Islamic finance. And I think, Dr. Umar, you would be able to help me out on this one. Just given your expertise in Islamic finance, I'm particularly curious on how relevant digital economy is in general, or fintech applications in particular, in relation to Islamic finance, and whether one can expect it to become a key component of Islamic finance. Now, when I say relevant, I'm referring, of course, to its permissibility, but also its role in driving commercial operations in those countries that have a large Islamic finance market.
Yeah, definitely. I mean, digital economy, it's relevant to Islamic finance. The default rule for economic issues in Islamic law generally is that all commercial transactions are permissible in the eyes of the law, except where there are few legal restrictions. I underline few legal restrictions here, because again, you look at the general, it's like looking at the bigger picture, everything is permissible under the sky, except for very few things. Hence, digital economy as a new landscape carry out traditional economic activities is regulated under the general Islamic legal principles. In Islamic jurisprudence, there is an overarching objective of the law which seeks to facilitate economic activities in a seamless manner, where the law also seeks to remove all hardships. Technology has brought on emerging ease and seamless access to financial transactions. This itself is what the Islamic law seeks to achieve. in its higher objectives, often referred to as Maqasid al-Shar'iyya. One of the key higher objectives of Islamic law is to enable, establish, facilitate, preserve, and protect commercial and financial transactions, otherwise known as Hifz al-Mal. Therefore, in Islamic commercial jurisprudence, all benign innovations are permissible unless there's an explicit prohibition in the legal text of the Quran or Sunnah. And these are generally considered as the primary sources of Islamic law. Based on this premise, all transactions undertaken through or facilitated by technology are permissible, provided the substance of such transactions are in line with the requirements for a valid contract in Islamic law. Any of such contracts must not contain any element of contractual uncertainty. In essence, facilitated financial and commercial transactions through the help of technology under the general purview of digital economy aligns perfectly with the fundamental objective of Islamic law. One of them, which we just mentioned, that is preservation and protection of property or wealth. Such objective properly fits the underlying philosophy of digital economy. As a result, the relevance of the digital economy to Islamic finance cannot be overstated. I'll give some examples from the State of the Global Islamic Economy 2022 report, where it was reported that Muslims spent over $2 trillion in 2021 across various sectors, including food, pharmaceuticals, fashion, cosmetics, tourism, and recreation. Muslim spending is expected to record a growth rate of 9.1% in 2022, according to that report. With the fast track of the fourth industrial revolution, triggered by the COVID-19 experiences across the world, particularly the lockdowns, one can conveniently conclude that majority of the spendings among Muslims in 2021 were carried out through digital channels. From the developments across the Muslim world in the past decade, it's crystal clear that digital economy is gradually becoming a key component of Islamic finance across various jurisdictions. Apart from the halal ecosystem, which has embraced e-commerce in its business delivery, the financial sector is now dominated by digital banking, sukuk and blockchain, automated Islamic investment platforms, and web-based Islamic crowdfunding platforms. Major jurisdictions with rapidly growing Islamic financial markets such as Saudi Arabia, Malaysia, Indonesia, Bahrain, United Arab Emirates, Qatar, Kuwait have adopted fintech in their financial services. Therefore, digital economy is significant in driving commercial and financial operations in such jurisdictions. From the payment systems to trading platforms and peer-to-peer financing, robo-advisory and crowdfunding platforms, virtually all aspects of Islamic financial services are fully integrated into the digital economic global landscape. For instance, in Malaysia, there was this framework that was introduced. It's called the Licensing Framework for Digital Banks. And it was introduced by the Central Bank of Malaysia on the 31st of December 2020, which expressly applies to licensed Islamic digital banks. According to the Malaysia Central Bank, technology-based innovation have become more entrenched within the financial sector, enhancing its service and delivery efficiency gains, and ultimately contributing to the development of the broader economy. Therefore, in order to boost the digital economy and drive commercial and financial operations, the central bank believes that this kind of regulatory framework that is conducive for enabling innovations in a safe and sound manner, it's important. The regulatory framework introduced in Malaysia is also applicable to all Islamic digital banks. And in Malaysia, existing licensed Islamic banks can apply to undertake Islamic digital banking business operations through, first, a separate unique entity as a subsidiary. Second, they can also do it through a joint venture arrangement with another entity, or third, they can adopt the approach of a full digitalization of existing business operations. Now, for the first two, where you have a new separate entity being established as an Islamic digital bank, there is a need to apply for a banking license, definitely, through the central bank. Now, for the second option, where you have a joint venture arrangement with another entity, there's also the need to apply for a license. However, for the third option, which talks about full digitalization of existing banking business operations, there is no need for a banking license to operate in Malaysia. And just recently, I think on the 29th of April, 2022, out of about 29 applicants, the Malaysia Central Bank announced 5 successful applicants for digital banking licenses, further to the approval of the Minister of Finance of Malaysia. Out of the 5 newly licensed digital banks, 2 of them were licensed as Islamic digital banks. So you can see the kind of developments we are witnessing in the market right now. So there's that full kind of integration between the digital economy and Islamic finance. And in the press release issued by the central bank to announce the license granted to 5 digital banks, the governor of the central bank emphasized on the importance of digital economy and digital banks as well. And she emphasized on financial inclusion. This is something, I guess, it's very important, and this is true for many Muslims across the world who are self-excluded from the financial sector due to their religious beliefs. Once acceptable alternative modes of financing are provided to them through Islamic digital banking, it is expected that such an important step will promote financial inclusion. In a similar vein, we've seen developments in Bahrain as well. You know, Bahrain had earlier introduced a framework for licensing digital banks, including the digital Islamic banks. Traditional banks as well as digital banks are licensed by the Central Bank of Bahrain under Article 40 of the Central Bank of Bahrain and Financial Institutions Law 2006. Hence, digital banks are required to obtain license from the Central Bank of Bahrain prior to undertaking banking businesses. Since digital Islamic banks are fully Sharia compliant entities, you know, Sharia compliant means they comply with basic principles of Islamic law. If they are to operate as fully digital banks that are not backed by existing banks, they have to be licensed like other Islamic banks under the Central Bank of Bahrain regulatory framework contained in the CBB rulebook. Now, these requirements include the legal status, mine and management controllers. I mean, you have a long list of things they need to comply with. And the objective of the law, generally, apart from complying with the Sharia, is to ensure investors are well protected. Similarly, in Saudi Arabia, the central bank introduced what it calls, new licensing guidelines for digital banks in the country. And that was on the 24th of February, 2020. These additional guidelines are meant to supplement existing banking licensing requirements under the banking licensing guidelines and minimum criteria. While focusing on digital-only banks, the new guidelines define the term digital-only bank as a bank that conducts a banking business mainly through digital channels. And the banks also include, Islamic banks, generally. And I'm sure, the listeners are aware of some developments in Saudi Arabia. Now, I think we have up to 5 digital banks operating at the moment. You have the STC, which was licensed, I think, in 2021, as well as the Saudi Digital Bank. Beyond the banking sector, blockchain technologies have been adopted in the Sukuk issuance process. Sukuk is the Arabic word for Islamic bonds. Just like the conventional bonds. In the Arabic philology, it's called Sukuk. Basically, raising money from the capital market is key to economic development in any country. And when this is enhanced by the digital economy through what we call sukuk on the blockchain, that itself, will help in reaching, the retail market. What we see in most sukuk market, it's more of wholesale. There is no kind of retail sukuk except in few countries. So, we believe raising money from the capital market is key to economic development in any country. And when this is enhanced by the digital economy, such endeavor enhances, transparency, speed of executing the transaction, and validation of ownership in a seamless transaction process. The first ever Islamic bonds issued on the blockchain was issued in October 2019 by Blossom Finance, and that was through the platform they call the Smart Sukuk platform. This Sukuk or Islamic bonds issuance was carried out by BMT Bina Umar, a microfinance institution in Indonesia. Now, the securities issued on the Smart Sukuk platform ran on the Ethereum blockchain that supports smart contracts, which facilitated secure transfer of Sukuk certificates that represent ownership of the underlying assets. The positive social impact of such issuances through financing of real assets has further deepened the relevance of Islamic finance in modern economies. This, among others, has made the digital economy a key component of Islamic finance. Thank you.
Perfect. Thank you. Thank you very much for that quick rundown. I think this is a topic that really deserves a panel on its own. It's such a big topic, I'm aware, but I think it was essential for me to raise this here because it's important to have that view of how fintech is really rapidly making its way to the conventional banking sector, but also the Islamic financial sector. And this is also, I think it's important to note that the Islamic finance markets are rapidly growing even in non-Muslim countries or non-Muslim majority countries. So thank you very much for that presentation. But in the interest of time, I'm not going to drag the discussion further on this, although it's a very interesting one. I'd like to move on to a more, also another topic, a very specific topic. And going back to you, Dr. Heba, you've already mentioned different initiatives in relation to central bank digital currencies. But more specifically, I actually read your paper on the growing interest of the Arab region in exploring and issuing CBDCs. So I would just like you to maybe take us behind the scenes of that study that you did for the AMF, and maybe highlight the status of these initiatives, and particularly what are the main driving factors that motivate Arab banks to engage in such trends. You're muted, sorry.
Sorry, thank you, Jana, for this important question. It's a very important topic for the Arab region. And actually, what you have mentioned about this study, that the study was the first study to discover the activities of the Arab Central Bank or their efforts in exploring the opportunities to issuing central bank digital currency. And the significance of this study actually it's based on a survey which is fulfilled by the 17 Arab central banks. So this is the majority of the central bank of the Arab region. And the study concludes that like other international central banks, Arab central banks are interested in exploring opportunities to benefit from issuing central bank digital currencies, which are considered now as the top of the future priorities of these banks. According to the recent survey conducted by the Arab Monetary Fund, 76% of the Arab Central Bank are currently studying opportunities to issue central bank digital currencies. Among these central banks that are already interested in exploring CBDCs, 3 Arab central banks have already engaged in ongoing projects to issue central bank digital currencies. While in contrast, the most Arab central banks are still in research, development, and proof of concept phase. So many other aspects already highlighted in this study. We have 2 Arab central banks expected to successfully issue such currency during the next 3 years. The largest proportion of the Arab central banks, which is around 89%, expected to be able to issue central bank digital currency within a period ranging between 4 to 10 years. So we are talking about only 2 Arab central banks that expected to successfully launch CBDCs in the short term, while other central banks already expect this move to be during the medium and the long term. As for the type of issued CBDCs, 69% of the Arab central banks are still in the process of determining the type of CBDCs to be issued. However, 95% are interested in issuing more than one type of digital currency, either wholesale, retail, and when we are talking about resale CBDCs, we are talking about hybrid or direct retail CBDCs. The moves of issuing central bank digital currencies, as you know, differ between countries of the world according to many factors, including of which the income levels, the efficiency of the payment system, the level also of financial inclusion, and the need to ensure compliance with the international regulatory requirements. So in this context, the study distinguished between the motives of issuing CBDCs, whether it's retail or wholesale. So at the level related to the retail CBDCs, the major motive for the Arab Central Bank to issue retail CBDCs is to increase financial inclusion, and this was the case for 69% of the included central banks, while 63% of the Arab central banks are interested in issuing CBDCs or retail CBDCs to increase the efficiency of the local payment system. And actually, these results are in line with the similar results noticed in several other developing countries, according to the trends monitored by the BIS survey, which is regularly released by the BIS related to issuing CBDCs in either developed and developing countries. From the other hand, and when we are moving to the motives of issuing wholesale central bank digital currencies, we find that consideration of combating anti-money laundering and terrorist financing operation came at the top of priorities of most Arab central bank from issue wholesale CBDCs, and the percent was 56%, followed by increasing the efficiency of the monetary policy transmission mechanisms, and this is mainly is based on the significant role of the wholesale central bank digital currency in increasing the efficiency of the interbank market based on the distributed ledger technology, or DLT. The study also refers that the road towards issuing digital currencies is still long for most Arab central banks. The survey refers to some critical challenges in this regard, including the nature of the existing legal and regulatory frameworks, governance consideration, technological challenges, namely requirement, immaturity, interoperability, shared infrastructure, and identifying private and public component in the supply chain of CBDCs. The study concluded with some recommendation, perhaps the most important of which is the need to strengthen the capabilities of the Arab Central Bank in exploring opportunities for issuing digital currencies by engaging with regional and international partners to exchange expertise and experience and implement a pilot project in this field. It's also essential to ensure the basic requirement for issuing such currencies, including developing the supportive legal and regulatory framework, ensuring data protection and cybersecurity, enforcing CBDC's governance framework. The study also indicated the importance of partnership between central banks, the private sector, and also the technology companies, in addition to supporting the capabilities of central bank employees in all areas related to the issuance of digital currencies. And in this context, also, I would like to refer to one of the most prominent experience of issuing CBDCs in the Arab region, which is Aber project, which is a joint project between the central bank in Saudi Arabia and the United Arab Emirates. And this project was mainly to experiment the possibility of issuing a common wholesale central bank digital currency between the two countries, which is aimed to facilitate the cross-border settlement of cross-border transaction between United Arab Emirates and Saudi Arabia across three main dimensions. One is between the two central banks, and the second is between the commercial banks within each jurisdiction, and the third dimension is between the banks in the two countries. And actually, after many experiments, this project is proven to be successful in increasing the efficiency of the central bank, wholesale central bank or cross-border wholesale CBDCs in increasing the efficiency of the payment system between the two countries, and is considered one of the important projects of CBDCs in the Arab region. Another initiative also are in their way to be released, like the case in Lebanon or in Egypt through the regulatory sandboxes, which already have many initiatives to explore the requirements of issuing CBDCs. Thank you, Jana. Thank you so much.
Thank you very much again for that quick presentation. Again, this is a very wide topic and it's a very big study that I encourage everyone to read, because I think it's one of the leading studies, I think, or one of the first studies of this kind in the region. So thank you very much. Now, I think we've covered a whole range of issues, from the importance of regulation, from this will to really encourage fintech applications to boost economies. We've also covered a whole range of issues, specifically private international law issues, as Dr. Umar has raised. From that, we also raised the issue of financial inclusion and wanting to increase efficiency of payment systems. Now, in light of all of this and everything that we've discussed, I would like us to particularly conclude on maybe just summarizing the specific or concrete cross-border issues that arise from all of the developments that you have kindly presented, and maybe try to conclude on the importance of specific cross-border regulation that caters to these fintech or DLT applications. Dr. Umar, would you like to give us your legal perspective first before Dr. Heba concludes on her economist perspective?
Sure. There are indeed a number of cross-border issues that may result from the digital economy and the proliferation of fintech and varying degrees of regulations across various jurisdictions. Similarly, the financial free zones, as we've explained earlier, and the CBDCs, as explained by Dr. Heba, and even Islamic finance, some of these issues have actually, led to some cross-border issues. But again, you have to consider to what extent, do you really want some of the kind of institutions like multinationals, international organizations like HCCH and others, to what extent do you think they should actually intervene, whether there's a need for a cross-border kind of regulation? I think that's quite important at the end of today's discussion. Now, with respect to financial free zones and their potential widespread in enhancing fintech regulation, it is important to emphasize that despite the advantages we discussed earlier, which are associated with such free zones, there are some legal issues that require the attention of major stakeholders, when it comes to cross-border transactions on the e-commerce platform. The example I gave earlier relating to the digital free trade zone in Malaysia and the potential cross-border legal issues, particularly those relating to non-tariff barriers under the World Trade Organization agreements, could impede international digital trade. Also, tax exemption on goods bought and sold on e-commerce platforms, where a diminished value set is a welcome development. However, it may lead to further issues relating to balance of payments among different nations. This challenge can only be solved through cross-border legal arrangement and tax exemption involving goods sold on e-commerce platforms under free trade zone. Now, regarding the central bank digital currencies, as discussed earlier, CBDCs will require a cross-border legal framework from the AML-CFT perspective, because this is really needed to ensure common standards across different jurisdictions. In the case of cross-border CBDCs arrangements, proper allocation of AML-CFT, the anti-money laundering and counter-terrorism financing, responsibilities will be necessary. Who bears the responsibility for what? At what stage do you conduct these checks? the KYC, and how do you prevent money laundering? So I think there is a need for the allocation of responsibilities when you have such cross-border transactions, particularly when it's a cross-border CBDCs, a foreign CBD is being used in a particular country. Now, perhaps a collaboration with the Financial Action Task Force, the FATF, to come up with a framework will help in the cross-border arrangements. It is pertinent to note that the FATF did not include CBDCs in its guidance on vertical assets. No, I think it was on virtual assets here. They didn't include this in their guidance on this, since they categorize CBDCs as fiat currency rather than virtual assets. To conclude on this point, there are a number of potential cross-border issues involved in the implementation of CBDCs. Some of the pertinent questions that need to be addressed as follows. Number one will be, how do you allocate responsibility, as I mentioned earlier, for AML-CFT responsibilities? What are the potential liabilities in utilizing retail CBDC for payment in another jurisdiction? Since the CBDC system is centralized at each country level, is there a provision for legal liability for the centralized system at the cross-border level, if any? How does the use of cross-border CBDCs agree with domestic legislation on legal tender? So these are part of the questions that should actually be discussed. Perhaps some form of coordination, legal coordination at the cross-border level will help in reaching a kind of, a well-informed position. Now, finally, with respect to Islamic digital banking within the overall digital economy, digital banks licensed in more than one country, whose customers transcend just one jurisdiction, may need to comply with some regulatory requirements which may differ from one jurisdiction to another. Since the Islamic finance business model is not premised on lending transactions, as they are only allowed to undertake financing of real economy, what happens when an Islamic digital bank finances an asset in another jurisdiction? What will be the governing law for such transaction? In addition, when Sharia or Islamic jurisprudential issues arise during the dispute settlement, whether in a competent court of law or in arbitration, what Sharia interpretation should the forum adopt? Should there be a unified legal and regulatory framework for digital banking, including Islamic digital banking, to reduce the cost of regulatory divergence on the digital banks, which is often passed to the customers? To avoid regulatory arbitrage, should minimum compliance requirements relating to consumer protection and privacy law be introduced? These, among others, I feel are questions that need to be answered through a cross-border legal coordination. Thank you.
Perfect. Thank you very much for that conclusion. I don't think I could have asked for a better conclusion, really. You ask questions that I have asked myself, and those are the type of questions that we hope can be answered soon. And I think this is the whole aim of CODIFI and what the HCCH is trying to do. So perfect. Thank you. Dr. Heba, I'd like to hear your conclusion, please, in light of everything that you heard from your perspective.
Yes, thank you, Jana, and thank you, Dr. Umar, for this excellent shedding light on the legal aspect of cross-border application for digital economy and in general, and fintech in particular. And as you said, the evolution of fintech industry, mainly in the Arab region, will have many cross-border implications, which will reflect the legal and regulatory frameworks in the coming years. Maybe here I will refer to certain fintech areas that will have cross-border application as follows. The Arab region is a major global source of remittances, as workers' remittances received by the Arab region now reached around $64 billion in 2020, and this constitutes around 10% of the global received remittances, while the paid remittances from the Arab region is estimated at around $122 billion in the same year, but with a major or with a bigger percentage of the global paid remittances, that is already about 20% of the global received remittances. So fintech technologies could be used to increase the efficiency of cross-border transaction, including remittances, In here, in this context, we could refer to that using a digital payment system based on DLT or CBDCs would have a transformative impact on the Arab economy. As you know, remittances are associated with a relatively high cost in the MENA region in general, ranging between 10 to 15% of the money transferred. So using digital remittances platform based on DLT technology like BitPesa, which is already a specialized platform for or initiated to facilitate remittances in Africa, could help decrease the cost of remittances in the Arab region by around maybe 75%, and it could also shorten the time required to execute such transaction from 12 days to 12 hours. On the other hand, also some of the crowdfunding platform working in the Arab region facilitate cross-border finance. So the central banks now tried to enforce this crowdfunding platform to cope with a strict regulatory framework that differ in the case of cross-border platforms, which should fully comply with the international laws, especially as Dr. Umar mentioned, those related to KYC, AML, and tourist finance. According to the previously mentioned studies on CBDCs, 29% of the Arab Central Bank now sees the importance of issuing CBDCs for both local and cross-border payments. While 18% of these central banks see the importance of issuing central bank digital currencies primarily for cross-border payments. So we are now facing many implications that could arise from the evolving of the fintech industries that have cross-border aspects. So based on all of what has been mentioned, there is a need, as Dr. Umar said, to revise all the regulatory frameworks adopted in the Arab region to ensure that fintech solutions comply with all the relevant international standards. And also some of this regulation should also take into account the importance of enforcing interoperability of the financial infrastructure supporting the digital economy or fintech industry application from day one of inception, whether within the same country or across border in some cases. And in this regard, I could mention two examples that adopted in Arab countries, in Egypt and Jordan, that the central bank laws already enforced the interoperability of all the financial digital infrastructure that are used by the digital economy or fintech applications. This is to facilitate all cross-border transaction from the inception of these technologies or from the operational perspective. So as you mentioned, Dr. Umar, and as you confirmed, Jana, the cross-border implications of the digital economy and fintech industry is very important. We need a standard setting for many aspects of digital economy, CBDCs, crowdfunding, e-commerce activities. All these activities need minimum level of standard, international standard to be adopted in the Arab region to facilitate all the benefits that could arise from using these technologies at the cross-border level. Thank you, Jana, so much.
Thank you very much, Dr. Heba. Thank you very much for that conclusion. And just to give a very brief summary for our audience, today, I was very lucky to have really participated in this panel because we've discussed a whole range of issues. We've discussed the regulatory approach in the Asia-Pacific region and the MENA region. We've also focused on the Islamic finance aspects and how how these markets are getting ready to really accommodate fintech applications and new technologies in this area, and how important these new innovations are. We've also discussed approaches to or initiatives to explore CBDCs in the Arab region, And finally, we also concluded on different cross-border issues and the need for cross-border regulation. And I think this conclusion is exactly what I wanted because I got both a legal professional and an economic consultant to really agree on that, on one conclusion. So I think this is a win for me. So thank you both for really giving us this really comprehensive and interdisciplinary perspective on these new developments and trends that we're seeing in the Asia Pacific and MENA region. I think this was a very valuable discussion in a very valuable conference. So thank you very much for your time and for sharing all your knowledge with us. Thank you very much for the HCCH.
Thank you so much.